Got it. Got it. And then HOAs, I heard you mention that HOAs are not deductible.
Yeah, people get that confused. They think, okay, homeowners association and homeowners insurance,
Mm-hmm.
so those two items are not deductible on your tax return.
Right. So if I were to buy a condo or a townhouse and I had to pay $300 a month for the HOA and then another $200 a month for the mortgage, my homeowner's insurance, I get to write off the $200 a month, not the HOA.
Correct. In 2020, not in 2021, which we're going into here. So, yeah, that's
smoke and mirrors. It's all smoke and mirrors. You always wind up paying about the same anyway. Just depends on how you eat it.
Rules change all the time. So, in fact, the Senate's getting ready to put out a bill regarding PPP, and it's probably going to come before the end of the year. So, rules change all the time.
So Renee, I have a question for you, and this gets asked again quite frequently. I'm doing repairs to my home, just maintenance kinds of things that have to be done. And that repair then leads to, let's go ahead and upgrade our kitchen, or let's upgrade our bathroom. And then all of a sudden, honey, we got a leak in the roof. And so, oh my gosh, I've got to bite the bullet and get that roof done. So the difference between repair my fence, put new granite in my kitchen, repair my roof, all of those, what is tax deductible, and can it be taxed? Can that deduction be taken in the calendar year? And the other question, Renee, part B of that is, I've heard that some of those deductions that are not allowable during the course of you being the owner of the home, when you sell your home to reduce maybe your capital gain exposure, certain deductions can be made. Can you help us with that?
Absolutely. It's something that can be very confusing. The IRS has strict rules on what home improvements are. And let's talk about and give some examples of home improvements. So if I paint my walls, that's not improving my home because I'm painting my walls. It's a repair, it's a maintenance kind of thing. That's not deductible. But if I want to replace the floor in my living room, and I'm going to make a very obvious example. If I have laminate in my bathroom and I replace it with laminate, that's like kind, replacing the like kind. But if I have laminate in my bathroom and I want to upgrade it, improve it with tile, then I can deduct that because it is an improvement. So if you repair your roof, you're just maintaining your home. But if you replace your roof or build another bedroom on the back of your home, or build a swimming pool, or anything like that, that's an improvement, you're going to want to keep track of that. And I would say the best way to keep track of those improvements is just to have a file folder in like a home office and throw the receipts in there, because after you've lived in the house for 2-3 decades, it's going to be difficult to kind of recreate all of those improvements that you've taken. Now, as far as deductibility, getting to, I think that's your part B of the question, you cannot deduct these improvements in the year that they are upgraded. What happens is when you sell your home, all of these improvements that you make will reduce the amount of the gain of your selling your home, and you pay taxes on the gain, depending if you meet the exclusion or not. And that might be a great next question.
What is the exclusion? Yes, that is a great question. What is that exclusion?
So when you sell your primary home, how you calculate the gain, let me see if I can explain this in English. Let's just say that you sold the house for $1 million and you bought the house for $800,000. No tax is going to be due because the IRS gives you an exemption of $250,000 per person. So if you're married, the exclusion rate is $500,000.
Okay.
So if we take a similar example, you sold your house for $1 million and you had $200,000 worth of improvements over a decade, your gain would be $800,000. And so taking that exclusion of a married couple of $500,000, then your gain is now $300,000 that you would pay taxes on. And the good news is that that $300,000 is not going to be taxed at the income tax rate. It's going to be taxed at a capital gains rate, which is different. And I would say most people will pay about 15% capital gains rate. There's a 20% capital gains rate, but that's when your income is higher, like high 400,000s over 500,000. But most people will pay about 15% on that gain.